The company that is researched by us is Luckin Coffee. Luckin Coffee is a coffee company from China that has founded by Charles Zhengyao Lu. It was established in 2017 and started operating in 13 cities such as Beijing and Shanghai in January 2018. Luckin Coffee has become the second largest coffee brand in China by opening 1,300 stores by October 2018. Luckin Coffee's rapid growth is because of the aggressive marketing strategy, which is 3 times more than the earning. Luckin Coffee released new technical products, which are the Luckin Coffee Express and Luckin Pop Mini. Luckin Coffee Express will use the Swiss-made coffee maker in the future as self-service coffee machine. Luckin Pop Mini is a vending machine, and Luckin's vision is to create world-class coffee brand.
Assalamualaikum and hi, my name is Alia. Now it's my turn to proceed the presentation, and what I'd like to do is to go through the timeline event about what happened to the Luckin Coffee. In January 2020, the short seller Muddywater Research posted an anonymous report stating that Luckin Coffee mispresented its financial statement in year 2019. After the report or article came out, the Luckin Coffee denies strongly this allegation. On 2nd April 2020, the Luckin Coffee suddenly admit to the fraud. They say that they conducted an internal investigation and found that its chief operating officer, Qian Liu, had fabricated worth $310 million of revenue. Definitely, he was fired, and as a result, this wipe out almost $5 billion from the company market value. Then a month later, the board of directors decided to fire Jenny Qian, who was the co-founder and the CEO of Luckin Coffee. Then in June 2020, the NASDAQ decided to delist Luckin Coffee shares from the exchange. Then the Luckin Coffee requested the hearing with the NASDAQ, and the purpose of this hearing is to let the Luckin Coffee to present the compliance plans for the future. But suddenly the Luckin Coffee withdraw the request from having that hearing, and it might be because of the they are not done with the internal investigation to figure out who else in the company involved in the fraud. Then on 1st July 2020, Luckin Coffee announced the result of its internal investigation and confirmed that the about $300 million in revenue and $190 million in costs and expenses were fabricated in 2019. Then a few months passes. On December 16, 2020, the United States Security and Exchange Commissions settled the accounting fraud case with Luckin Coffee for $180 million. For the conclusion, as the lesson for the future, Luckin should have created and applied a stronger code of ethics throughout the company, from senior management to the frontline staff, in order to detect fraud at the earliest stage and to remain consistent with commutative justice. That's all from me. I will pass to the next presenter. Thank you.
Hello everyone, my name is Shakti and my matrix number is 280505. So today I'll be talking about the effects of the scandal towards the auditors. Right, the first effect will be resignation of auditor committee in a short period of time. As we all know, these auditor committees, which are Tian Ru Pu and Sean Shao, as a committee auditors, supposedly need to check internal controls, but they failed as an auditor committee because they were cheating on transaction, although they were in charge of that. And this shows how unethical they were in terms of checking the financial statements and stuff, and this made them to allege the financial statement, which is supposing not to be done by the auditor committees. Alright, the next effect would be withdrawal of being an auditor from client. Our external auditor for Luckin Coffee is EY, which is also known as Ernst & Young Huaming LLP. they had this conflict of interest between EY and also Luckin Coffee. So without any further thinking, they had to look over the client's interest more, because from there they get the revenue, as it's a commercial firm, so they have to build a very good relationship with the client. And this shows that they have failed ethically, because they were looking more into client's interest compared to the public's interest, which was supposedly wrong, as it's a failure in terms of transparency and integrity. As an external auditors, that is very important to have the transparency and integrity. The third effect of the scandal towards the auditor is the launching of internal investigation. This internal investigation had to happen because in terms of external auditor, which is the EY, they were working for the Luckin Coffee as an external auditor. They were the first to be claimed to discover the fabricated transactions in the company's 2019 financial statements. But however, it wasn't really get into the management or any other important parties. So it initiated an internal inquiry by the auditor committees, because they had also found out the fabricated transactions. As these transactions, the auditor was not mainly involved in this fabricated transaction, but it was actually involved by the chief operating officer. So this had caused the fabricated statement to be investigated, and it had caused the Luckin Coffee to drop off profit, and it has been delisted from the Nasdaq. Next is the fall of reputation of an external auditor. This is because public still doesn't believe that external auditors was not involved in this fabricated transactions. But however, they still had this question running in their mind, so they made this question to go on and prolong. So they created a very bad impression towards EY, and the reputation gets lower. So that is why EY was not believed to be unsupportive towards the fabricated statements. And that is all from me. Thank you.
My name is Nur Izzah, and now I would like to continue with the involvement or roles of the auditor in this case. Auditors plays important roles in detecting fraud in the company. It is the responsibility of the auditors for Luckin Coffee to identify issues happen there and take action. There are a few roles of the auditors regarding the scandals of this company that happened for the past few years. Firstly, the auditor should identify and assess the risk of material due to fraud in the financial statement. In order to do that, the auditor itself need to have presumption that there will be risk of fraud in the firms. So they need to evaluate which type of revenue transactions or accessions that will give rise to such risk in the revenue recognition. However, in this case, we noticed that the auditor of Luckin Coffee, which is EY, already aware that there is fabricated statement in the company, but they do not take any action regarding this issue. The right way to act while facing this situation is that EY must evaluate the possible failure due to matters that are uncertain, which can be said as risk assessment, where they need to investigate the whole company by carrying out the audit procedure. Audit procedure is likely to be used for detecting any material misstatement in the financial statement that are responsive to assess risk of material misstatement due to fraud at the accessions level in terms of nature, timing, and extent. The other role of auditor is they need to communicate with management and those charged with governance. So, if they suspect any misconduct in the company, they should report it whether to the management or governance in the timely basis. In this case, we could see that the fraud also involving the management of Luckin Coffee, where there is evidence they are asking their employees to fabricate the transactions. But EY choose to stay quiet and withdraw as an auditor of the client because the conflict of interest occur between these two parties. Due to these reasons, the auditors fail to fulfill their responsibility as an auditor, which is to communicate with the governance, as the management of the company also involved in these issues. That is all from me. My friend will continue with another rules.
Assalamualaikum and hi everyone. My name is Afifah Nabila binti Zakaria. My matric number is 272956. I will continue with the role of auditor. Okay, the next role of auditor is to assess the organization's internal control. This is because the effectiveness of an organization's internal control system is examined during an internal control evaluation. Okay, Based on the Luckin Coffee scandal, an internal audit function on 1st July 2020 is to assess and evaluate its control system. As of 31st December 2019, the internal auditor's role include identify some material that related to the weakness in Luckin Coffee's internal control over the financial reporting. According to the findings, the weakness identified as of 31st December 2019 include a lack of sufficient entity level of control policies and procedure, a lack of sufficient accounting and financial reporting personnel with the necessary knowledge and experience in applying US GAAP, and lack of financial reporting policies and procedures that are comparable to US GAAP. So, in this case, the financial fraud centered on the management. The fundamental reason is that Luckin Coffee's internal control system lack an effective restriction on the power of the management, which leads to the excessive authority of the management. Thank you.
Greetings everyone, I'm Nageshwari Paramasivan, matrix number 264741. So I'm going to continue on the involvement or role of auditors in Luckin financial scandal. So my main point is violation of code of ethics. The 5 key principles in audit profession that defines ethical standards are integrity, objectivity, professional competence and due care, confidentiality and professional behavior. According to this case, ethical analyses were conflict of interest, dishonesty, misuse of position power, and failure to fulfill fiduciary duties are addressed at all levels of Luckin company, involving senior management, the board of directors, audit committee, internal auditors, and external auditors. So now let's focus into what are the involvement or role of auditors in this case. An audit committee's role is to monitor whether the company upholds the code of ethics or not. But the audit committee of Luckin remained silent on this issue and failed to warn the board of the probable ethics violations. They failed to conduct due diligence and question the fabricated transactions as well. On top of that, internal auditors at Luckin not only failed to notice the suspicious transactions, yet they cooperated and perpetrated the fabricated transactions and violated their code of ethics along with the management. Ernst & Young, as the external auditor of Luckin, has already detected and reported the fraud that inflated financial statements earlier to the board of Luckin. However, EY didn't bring this issue to the regulators and withdraw themselves silently as the external auditor when management of Luckin intentionally didn't take any further actions. A conflict of interest happened where the client's interest overrides the public's interest, since the revenue of EY as an audit firm is solely based on its relationship with clients. Hence, EY behaved unethically by failing to report the potential fraud to the regulators. Instead, they focused on the client's interests and violated the duty of transparency and integrity. That's all from me. I'll pass to the next presenter. Thank you.
Luckin Coffee's rapid growth is contributed by aggressive marketing strategy that consume huge amount of money. In order to illustrate that Luckin Coffee is a valuable company to be invested in, Luckin has fabricated its number of sales. High sales company will let every external user think that Luckin Coffee can generate a lot of revenue and worthy of investment. When a company is involved in financial scandals, several parties are responsible for it. In this case, the board of directors, internal and external auditors are liable for it. They can be considered as colluded together to get benefits from this fraud. Luckin should have adopted and enforced a code of ethics throughout the organization to discover the fraud early and avoid commutative justice violation. External auditors should have been more proactive in companies' misbehavior, and they should have avoided guaranteeing financial performance to third party until they had completed their due diligence. Thank you.